You're welcome to this channel where I share knowledge on academic and professional issues. And you're welcome to subscribe to this channel if you have not done so. I'm actually working on a series where I explain with detailed examples, but practical examples, the International Financial Reporting Standards, which is very important for students of accounting, certifications, auditing certifications, and even for accountants and auditors in the professional cycle. All right, so I'll be looking at IS2 inventories today. Earlier we've discussed IS1. Okay, so you could check the previous video on IS1, and I'll be looking at subsequent standards in other videos. Okay, so let's look at IS2 inventories. One of the radical changes that IFRS brought to the accounting terminologies is the emphasis on that word inventory rather than stock. Okay, I remember when I was writing Institute of Chartered Accountants of Nigeria examinations many years ago. Right, we used to use stock and inventory interchangeably. Okay, but now IFRS says that's not the best. Okay, because the word stock, when we use it in for capital shareholding also. Okay, so you find stock being used in as another word for share capital, stock being used another word for inventory. So which one do we pick? Okay, so basically professionally now we use the word inventory. Okay, so the objective of IS2 is to prescribe the accounting treatment for inventories. So as an accountant in the field, how do you treat an inventory transactions that involve inventory when you are posting? Okay, a primary issue in accounting for inventories is the amount of cost to be recognized as an asset and carry forward until the related revenues are recognized. This standard provides guidance on the determination of costs and its subsequent recognition as an expense, including any write-down to net realizable value. Of course, as we will soon learn, we know that as we soon learn that the fact that inventories can lose value. Okay, so you may have situations where you may need to write down the net book value of an inventory because of impairments, okay, obsolescence, being damaged, and things like that. So for us to be able to have the actual value of the inventory, and that is why IS2 is very, very conservative, is very, very careful, all right, in assigning value to inventory, and that is what brought about the concept of net realizable value. All right, so you have to compare the costs of the inventory with the net realizable value, and always go for the lower of cost and net realizable value, so that you don't overstate the financial statement. You don't overstate your current assets. All right. It also provides guidance on the cost formulas that are used to assign cost to inventories. All right. I remember, like I said before, when I was writing ICANN examinations, we used on inventory. We learn how to use first in, first out, last in, first out, LIFO, weighted average method, and so on. Okay, but LIFO is not one of the recommended method to be used in costing inventory by IS2. Okay, so basically you use last in, first out, or you use weighted costs method, or if your policy allows standard cost and the rest, but you cannot use last in, first out. Okay. The scope now, the standard applies to all inventories except financial instruments. Okay, so financial instruments, you have to look at other standards for that. Biological assets, you have to look at IAS 41. All right, so basically every other inventory are covered by IAS 2. Definitions: inventories are assets, all right, held for sale in the ordinary course of business. So that definition is very, very important. So it's basically your production goods, right? What you sell in the normal course of business. That is what inventories are. Inventories are assets in the process of production for such sales. Talking about the work in progress, WIP. So work in progress, finished goods, all of them can be categorized as inventories. All right, even your raw materials. All right, so that's what he's talking about. In the form of materials or supplies to be consumed in the production process or in the rendering of services. So your raw materials, your work in progress, your finished goods are all classified as inventories. All right, I talk about net realizable value, and the concept of net realizable value was brought so that we don't overvalue assets, we don't overvalue inventories. All right, so you bought an asset, an inventory 1 year ago, right? But now perhaps the inventory, the asset is no longer in demand. So because of that, the price it is commanding has fallen. It will not be fair to the users of the financial statement if you retain the original cost, because actually by the time you sell that inventory, you are not going to get that cost. You're not going to recover that cost. So tell us, all right, what the reality is now. That's what the realizable value is all about. So tell us, so look at the estimated selling price, all right, then deduct the estimated cost of completion. For example, if it is a work in progress, an estimated cost necessary to make the sale, that is selling cost. So basically, net realizable value is basically the estimated selling price, the current value, the current selling price, if we take the asset of the market, less estimated cost to complete the asset, if applicable, then less selling costs. All right. So basically, whatever that net realizable value gives you, compare it with the cost of that asset. Whichever one is lower is the value of the inventory. All right. So talking of estimated selling price, the fair value of the inventory. So for definition of fair value, we have to look at IFRS 13, fair value measurement. Fair value is the price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. All right, so fair value is the price you get when you sell an asset, or the price you paid when you settle a liability in an orderly transaction. You are not under pressure. It's not a forced sale, all right? All right, between market participants at the measurement date. So that is what we mean by fair value. Basically, streets, the street terminology is actually, the market price. When you go to the market, the price that is known, available to both the buyer and the seller, that is what is called the fair value. Now let's look at measurement of inventory. I've been talking about it. This is actually the key provision of IAS 2. All right, inventories shall be measured at the lower of cost and net realizable value. I've explained what net realizable value is. All right, what is the selling price? All right, find the cost to complete, find the selling costs. All right, then whatever that gives you is your net realizable value. Compare it with the cost. Whichever one is lower, that is the value of that particular asset. Okay, so cost of inventory. What makes up an inventory costs. Okay, so you need to look at the cost of purchase. How much did you buy that inventory? For example, the raw materials. How much did you spend in conversion? All right, from raw material to work in progress, from work in progress to finished goods. All right, and all other costs incurred in bringing the inventories to their present location and condition. So every cost that you incur in moving the asset, the inventory to its location, upgrading it to the level it is now, maybe ready for sale, all those costs must be added to the inventory cost. So that's why we have to track our expenses or our spendings, our expenditures on the inventory. All right, cost of purchase. The cost of purchase of inventories comprise the purchase price, import duties, all right, and other taxes, other than those subsequently recoverable by the entity from the tax authorities. So whichever tax you're going to add to the cost of the inventory must not be recoverable. That's what that is saying. Transport, handling costs, and other costs directly attributable to the acquisition of finished goods, materials, and services. So trade discounts, rebates, and other similar items are deducted in determining the cost of purchase. So these are the makeup of the purchase price, purchase cost of inventory according to IAS 2. Now, I've talked about the cost of conversion, especially for production environment. So you bought raw materials, you have to still convert the raw materials, all right, into work in progress, from work in progress to finished good. So all those costs also, you need to be able to add them together to the cost of purchase. All right, then also remember your production overheads also that are directly attributable to your inventory. You also need to be able to factor those costs also. So the cost of conversion of inventories include costs directly related to the units of production, such as direct labor. They also include a systematic allocation of fixed and variable production overheads that are incurred in converting materials into finished goods. All right. So fixed production overheads are indirect costs of production that remain relatively constant regardless of the volume of production. So I'm sure you already have knowledge of this. You set up an inventory, you set up a factory. All right. There are some costs that they're just there, regardless whether you produce or you don't produce. It does not matter. Those costs will be incurred, and they don't change with your volume of production. All right, whether you produce 10,000 units or you produce 1 million units, it does not matter. All right. For example, now, maybe for example, powering the the environment. Okay, whether you like it or not, whether you work or not, there must be power in the office. Okay, or in the factory. Okay, whether you are producing or you are not producing, the power is just there. You're going to pay. Okay, so rents for the premises, the factory premises, right? You're going to pay. Okay, whether you even produce or not. Of course, a lot of times, especially maybe in this part of the world, you pay rent in advance. Okay, whether you make use of the rent, that's a problem. All right, variable production overhead are those indirect costs of production that vary directly or nearly directly with the volume of production. Materials, all right, when you produce 10,000 units, all right, the materials you will use, all right, indirect materials you will use will vary compared to when you produce 1 million units or so. And the same goes for indirect labor. All right, so cost of conversion. The allocation of fixed production overhead to the cost of conversion is based on the normal capacity of the production facility. So we have to be very, very careful. The fixed production overhead, like you said, is just there. Whether you produce optimally or not, okay, the fixed production overhead will be killed. But we said what we're saying here, what the standard is saying here is that the allocation of the fixed production overhead to the costs of the inventory must be based on your normal day, your normal capacity, your normal operational standard, operational gauge. Okay, so the normal capacity is the production expected to be achieved on average over a number of periods or seasons under normal circumstances. All right, taking into account the loss of capacity resulting from planned maintenance. So your normal day, your capacity on a day that everything goes right. That is the basis you use for allocating your fixed production overhead. Now, excluded costs. Examples of costs excluded from the cost of inventories and recognized as expenses in the period in which they are incurred. All right, abnormal amount of wasted materials, labor, or other production costs. So, of course, in costing, we have what we call a normal, you have losses. You have normal loss, you have abnormal loss. All right, so you cannot factor abnormal wastages into the cost of the inventory. You have to expense it. All right, storage costs, unless those costs are necessary in the production process before a further production stage. So storage costs, you cannot also add it to the cost of inventory. You have to expense it. Administrative overheads that do not contribute to bringing inventories to their present location and condition, and of course, selling costs must be expensed. Okay, according to IS2. Now let's look at this illustration on the allocation of fixed production overhead. So we have a manufacturing company that plans for fixed production overhead of $100,000, and annual production is estimated at 500,000 items in its financial year. Okay, the planned overhead recovery rate is 20.2 okay, or $0.2 per item, or that's okay, $0.2 per item. That is $100,000 per 500,000 items. So the planned overhead recovery is $0.2 per each item. I remember we have 500,000 items, so that would give us $100,000. A labor union strike, however, disrupted the plan. So we could only produce 400,000 units instead of 500,000. But the level of fixed production overhead was as expected. So the fixed production overhead was still $100,000. We said that it doesn't change. It doesn't change regardless of your level of production. Okay, in line with IS2, inventories determine the valuation of inventories in the financial statement. Now, so this is our answer. Remember, we said that the allocation of fixed costs should be based on a normal capacity. Okay, that is what we said here. Allocation of fixed production value to the cost of conversion is based on normal capacity of the production. Okay, so we will still use that 0.2. All right, the planned overhead recovery rate of $0.2. All right, but remember, we produce only $400,000. 400,000 units. We actually produce only 400,000 units. All right, so which means the valuation of the inventory is $0.2 multiplied by 400,000 units. That will give us $80,000 to be recognized in the statement of financial position as the valuation of the inventory. Okay, but remember, we actually have a fixed production overhead of $100,000. So what happens to the rest of the fixed production overhead, which is $20,000? So we have to expense that. So that 20,000 cannot be added to the valuation of the inventory, that according to IS2. So that extra $20,000 that you cannot add to the cost of inventory, you have to expense it. Okay, so that is what IS2 is saying. Okay, another part of the standard says an entity may purchase inventories on deferred settlement terms when the arrangement effectively contains a financing element. That element, for example, a difference between the purchase price for normal credit terms and the amount paid is recognized as interest expense over the period of the financing. So you have an inventory that you have bought. You normally buy for, let's assume you buy each unit for $10. All right, $10 per unit. Okay, and you are buying it in credits, or in credit on credit terms now. And so the seller is now telling you, okay, normally we should have sold to you at $10 per unit, but because you're going to pay over a period of 1 year, we are going to sell to you at $15 per unit. What this is saying is that, all right, you cannot just value that asset at $15, right? Because the actual value is $10. Okay, the extra $5 is actually an interest. All right, is an interest expense. Yeah, it's like they give you a loan. That's what that is saying. And so for accountants and for auditors reviewing financial statements, we have to be very, very careful because of clauses like this. So if the preparers of the financial statement did not take cognizance of this provision, then that means you have not prepared a true and fair financial statement, depending on the significance, all right, of this part of the amount of inventory, all right, relative to the total valuation of the statement of financial position. All right, so if you are buying an asset on credit, an inventory on credit, and because of the credit terms, an additional amount is being added to your purchase price, you have to separate the purchase price from the interest expense and treat them differently. All right, so the extra amount that is added to the cost of inventory must be expensed, all right, over the period of the financing as an interest expense. Very, very wonderful. Okay, cost of agricultural produce harvested from biological assets. All right, so in accordance with IAS 41, inventories comprising agricultural produce that an entity has harvested from its biological assets are measured on initial recognition at their fair value less cost to sell at the point of harvest. This is the cost of the inventories at that date for application of these standards. Okay, so that is the mapping of IAS 2 to IAS 41 agriculture. Okay, so for harvested biological assets, okay, so an entity has harvested from its biological asset, they are measured at initial recognition. So for those harvested biological assets, what is their fair value? Then less the selling costs. That's just cost to sell is just selling costs. All right. So fair value less the selling cost will give you the valuation at the point of harvest. Okay. Then techniques for the measurement of costs. Like I said, there are various methods that you can use for your costing. Okay. But don't use last in first out. Okay, so techniques for the measurement of the cost of inventory, such as the standard cost. So the standard cost is an internal costing arrangement within the organization, or the retail method, which may be used for convenience if the results approximate costs. Standard costs take into account normal levels of materials and supplies, labor efficiency, capacity utilization, and so on. They are regularly reviewed internally and if necessarily revised in the light of current conditions. Okay, the retail method is often used in the retail industry for measuring inventories of large numbers of rapidly changing items with similar margins, for which it is impracticable to use other costing methods. All right, for example, in a supermarket. Okay, so you have all manner of items in a supermarket. For example, the cost of the inventory is determined by reducing the sales value of the inventory by the appropriate percentage gross margin. The percentage used takes into consideration inventory that has been marked down to below its original selling price. An average percentage for each retail department is often used. So for the supermarkets, like maybe like ShopRite. So you look at ShopRite, for example, all manner of goods are found there, right? Sweets, biscuits, household goods, and the rest. So for a retail sector like that, they can actually use the retail method. All right, like we said, the cost formulas, you can use the first in, first out. So first in, first out means, right, the inventory that first gets to your warehouse, right, they are the one that you first leave, where you are, maybe when you are selling, you are selling the inventory in your stock in your store. Of course, you're going to have inventories being moved to your warehouse on different dates. So the question most of the time, the argument is, how do you value the inventory you are moving out of the warehouse? So we have an inventory at $4 per unit moved into the warehouse on January 3rd. We have the same inventory moved to the warehouse on January 10th at $6. Then by January 30th, we move the same inventory again because maybe there's inflation. All right, it's now maybe at $8. So when we are moving the inventory out, maybe to various customers, how do you value that? So what is now the price we are going to use? So that's where the first in, first out, and the weighted average cost formula, that is where they are applicable. So I will be ending this video here. In the second part of the IES2, I will be looking at solving calculation questions on application of first in, first out, weighted average cost formula, comparison between cost and the net realizable value. Okay, so I want you to stay tuned to the next video, the part 2 of IES2, for us to be able to do some calculations. So if you have not subscribed to this channel, kindly do so now. Thank you.